also to alert some of the taxpayers in California about that middle class tax refund program, which many people there, according to their statistics, haven't even applied for it. It's been available on credit cards, but anyway, the update. So I'll be doing sort of an update this morning.
Excellent, excellent. Okay, sir. I will talk to you later.
Okay, thank you so much, and thank you, Mr. Brown. Thank you, listening audience, both on the West Coast, East Coast, and across the seas, wherever you exist. This is Everett James, your trusty tax reporter, that comes to you every Wednesday morning at 10 a.m. for approximately an hour and a half, hour to an hour and a half, to bring you the latest in IRS directives and warnings. We're right now we're sitting at approximately 6 weeks past the tax filing deadline for 2023 this year. We'll be looking at 2024 tax filing. Wow, in approximately a little bit over 6 months. And I'm here to hopefully help prepare you for that. I plan to provide a session that will delve specifically into the W-4 form for folks who are employed and who are receiving W-2s from their employer. This is the W-4 has been really undervalued in the past, and not really given the importance it really deserves, because basically the W-4 is your directive to your employer to withhold money that will go toward your income tax liability, as well as your Social Security and Medicare liability. So that withholding is extremely important, because obviously at the end of the year, if you have not withheld sufficiently to cover your liability, particularly if you have a tax liability, then you owe money. The withholding amount, generally for many employees, has been sufficient to provide a yearly bonus, a vacation bonus. So as soon as the tax season rolls around, I start getting calls, and many customers acknowledge right up front they're looking to file their tax return. It has nothing to do with just complying with the tax law, but it has everything to do with taking that vacation they've been putting off. And as soon as their returns have been accepted, and the money, if they have arranged for bank deposits, as soon as that has arrived, they are gone. And I can guarantee you that many of them have have left the state for Las Vegas. And this is from personal experience. In any case, the first update that's extremely important is IRS has stats showing that a lot of California residents, and this just applies to California, really haven't used their middle class tax refund relief benefits. Are you one of them? Now, before we get into the details, again, my name is Everett James. I can be reached for questions and comments at 951-522-9877. For comments via the internet, please send your comments and questions to evjtax1 at gmail.com. Keep in mind that those who take advantage of this particular free service will be eligible for a full tax consultation for 2023 tax filing year. So the the California middle class tax refund. That tax refund, was really intended, to help folks who were having difficulty dealing with declining purchasing power to face high housing costs, healthcare, and everyday necessities. Now, the stimulus payments began 2 years ago, and they really continued through January of this last year. But despite more than 9.5, almost 10 million debit cards being sent out to eligible Californians, the data shows that millions of dollars in benefits remain unspent. Now, as a result, the California Franchise Tax Board has been urging residents to activate those debit cards. As I mentioned, it is there for you to assist mainly folks in middle income groups. Those who were eligible automatically received those payments, or were automatically eligible to activate the cards and benefit from those payments between October 2022 and January of last year. The MCTR, middle class tax refunds, they averaged generally between $200 and $1,050. The exact amount was just based on your income status, and the number of dependents. But California did send those funds to residents, but their records show that over 9.5 million cards were sent out, but millions in dollars have not been yet claimed. Now, to address this, the Franchise Tax Board reminds residents to activate their cards, encourages those who have not yet received their cards, and that would include everybody in the middle income groups, to contact the Franchise Tax Board to make sure they get their benefits. Some residents might not know the funds on the cards, can be transferred to a bank account of their own choice. Also, keep in mind that those cards are valid for, I believe it is 3 years from the date of issuance. So if you receive the card and haven't activated, go ahead and activate it. But if you have received a card that hasn't and you haven't activated, you may get a letter from Franchise Tax Board as a reminder. If you need assistance with activation, or if you remember getting it but don't remember where you put it and you need to replace it, if it got stolen or lost, call 1-800-240-0223. Now, if you have not received your debit card and believe you are eligible, ensure your address is updated with Franchise Tax Board. Visit the help with the middle class tax refund directions on updating your address. Is that this payment, is this something that is taxable? No, it's not taxable for California state income tax purposes. The franchise state tax did indicate last year, it did state last year, that it would not tax the refunds at the federal level. For any questions on that, please feel free to call this reporter to get started. What are some of the big changes that have taken place, that will take place rather, at the end of 2025, or what you might say, beginning in 2026. There's huge changes, and the big reason is the 2017 Trump era reform law. Many of the of the tax provisions that were passed in that tax law were really temporary, and they it was meant to expire after 2025, which is just next year. So keep in mind that when the 2017 temporary tax benefits, when they expire at the end of next year, the rules in effect will just go back to what was in effect in 2017. And what are some of the key expiring provisions? Well, the tax brackets, of course, did change. That can be, and generally, they start at 10%. That was something that has remained in effect. But I'm not going to go over all the tax brackets because they have different income level breakpoints. The big thing is that the biggest change, I would say, is the standard deductions. The 2017 law more than doubled as a result of the 2017 law, and that promoted the use of the standard deduction as compared to the itemized deductions that have been used by many taxpayers for years and years and years. But that doubling of the standard deduction really took away the incentive to use to apply for the miscellaneous itemized deductions. And just take the standard deduction. Wow, did that save? Did that save millions of error issues, and not to mention the inevitable tax review letters that come through the mail, and multiple audits. So that was the biggest change. The next biggest change, I would say, is in the child tax credits. Prior to 2018, it was $1,000. During the past few years, since 2017, the child tax credit, as you have learned, doubled to $2,000. So that's going to go out the door as of the end of next year. The $500 credit for each dependent who is not a qualifying child. That will no longer be in effect at the end of the next year, 2025. The higher exemption amounts and phase-out zones after 2017, of course, it resulted in far fewer folks having to pay the AMT. What is that? AMT? That's the alternative minimum tax. The qualified 20% qualified business income deduction for self-employed folks and people who own interests in S corporations, partnerships, LLCs, and other pass-through entities. That was another one of those temporary goodies that will technically no longer be the case at the end of next year, end of 2025. Another A big change was the amount of your income that you could deduct as cash donations to charities. That was increased from 50% to 60%. So at the end of next year, the amount that you're going to be for 2025, of course, you'll still get that benefit of being able to go all the way up to 60%. Those are the folks, for those folks, of course, who can afford to use that deduction. The cutback on high itemizations for upper income taxpayers with the return, and that will certainly apply to a lot of taxpayers out in states such as New York, New Jersey, Connecticut. The uh, the very, very high limit that they could go in and deducting their expense, deducting some of their um, expenses on the Schedule A. The and now there's been will be some some restrictions on some of the popular deductions will also end after 2025. The first big one is personal exemptions. At one time, you could take a deduction of $4,050 for yourself and each of your dependents. For example, family three could claim a $12,150 personal exemption, but the 2017 law eliminated that deduction. The $10,000 limitation on deducting state and local taxes. That was a 2017 restriction. Well, that'll be eliminated at the end of next year. And it's going to be a great news for folks who fit in, who are actually enjoying their higher than average income and who are saddled with high property taxes or high state income taxes. So they will not be limited to the $10,000 limitation that was imposed by the 2017 tax law. Miscellaneous item, I'd say one of the biggest changes has been in the availability of the miscellaneous deductions on Schedule A that are subject to the 2% of the AGI threshold. Keep in mind, of course, that all of those deductions on the Schedule A, particularly the unreimbursed employee business expenses, you could not really deduct them until you met that threshold, the 2% threshold. So you had to take all of your miscellaneous deductions, figure out what the 2% of it is, and then you can start to deduct the expense. Something similar to the medical 7.5% AGI restriction. And it never ceases to amaze me of the number of taxpayers who still are operating on the old rules, thinking that all of their unreimbursed business expenses or employee expenses can be deducted, and that is no longer the case. Has not been the case since the 2017 tax law. How about for individuals who have theft and casualty losses? Well, under the current law, since 2017, the only losses that can be deducted, it has to be in connection with a federally declared disaster area. So if you weren't in a federally declared disaster area, you really cannot deduct any casualty losses. At the end of next year, that will expire, and for those who have suffered theft losses and casualty losses. Well, at the end of next year, beginning 2026, if you do have sustained that kind of a loss, without being in a fairly declared disaster, you can once again be available to use it. Job-related moving expenses. Now, only members of the military get that particular break. The 2025 was also the last year for the benefits from the Obama health premium credit. But that premium credit was expanded to folks who buy insurance through the marketplace. And another item, which is certainly a huge concern for college students. Most loan debt, the student loan debt, is forgiven from 2021 through 2025. Most of those loans have been exempted from federal income tax. And that is an exception to the general rule that income from the cancellation of indebtedness is taxable. Well, we'll see how the Congress handles that area of taxation. For those for 2023 filers, if you did not, if you were if you were alert to all of the protections in the filing law and obtain an extension, that if you did obtain a filing extension, you have until October 15th of this year, 2024, to file your 2023 tax return. But keep in mind that only applies to the filing. That doesn't apply to actually paying the taxes that you owe. If you wind up owing money, it is still technically due. Was technically due to April 15th of this year. So you're already late if you weren't aware of that. If you can't pay the tax that you owe, at least make certain that you file. At least make sure that you file or have filed, hopefully by October 15th, and just check with your tax practitioners. Or check with the local IRS office if there are any that are actually available in your residence area, and see what you can do. See if you might be able to submit an offer in compromise (OIC), which would let you settle the debt for a lot less than what you owe. One thing to note, and this is for procrastinators who know that they are getting if you know you're getting a refund, you could file your 1040 past April 15th without getting an extension. And keep in mind that IRS can assess late filing penalties only in situations where taxes are owed. So if you know that you don't owe any taxes, you can can still file past the deadline of April 15th without having to pay a penalty. So for folks who are getting Social Security, or no, I'm sorry, for folks who are working and they have Social Security withholding, of course, from their wages. Just keep in mind that wow, I can remember when the Social Security wage base was under $100,000, but And would you believe that just by next year, that base on which the tax is applied, and that's going to be amounting to $176,700 for 2025. So it's that's a huge increase again. Um, the President Biden does intend and has stated his desire to make it easier for folks to buy real estate, and he's pushing two credits. One might be a refundable home buyer credit of up to $10,000 for buyers who have not again owned a home in the prior 3 years. That phases out at AGIs of $100,000. That's good for what you might call the middle class income, but so many taxpayers have wind up with AGIs of over $100,000, so that this credit would not apply to them. And he's also pushing the idea of a refundable home seller credit of up to $10,000. Again, the break would start to phase out if your AGI was over 100,000. Now, these are just they are the hopes and dreams, and undoubtedly having a lot to do with the political election coming up. That would be a big motivation for pushing some of these special tax breaks. Okay, so with that, we're going to move into just some updates from IRS and areas that you need to be aware of. One is mistaking a business for a hobby. Now, we are certainly in the age of the gig economy. Gig economy, I can recall first hearing that word gig in connection with musicians, traveling musicians. We're gonna. They would tell me about the gigs that they've or performances that they've had. And they had a gig here and a gig here, a gig in London, and a gig in the United States, and a gig in South America. Well, the gig terminology has now come to refer to any self-employment situation. If you do derive some kind of an income, from a self-employment arrangement, keep in mind that income is taxable. In addition to that, the expenses relative to that income are reportable and deductible on your Schedule C form. Now, what legally differentiates a hobby that you have from a fully profitable venture? IRS draws the line, a very, very obvious line between a business and a hobby. If the income that you get from the activity, if it is not categorized as a business or primary income by IRS, then you can deduct expenses, but the deductions are limited or restricted to the hobby, to the necessary expenses related to the hobby. If you fail to, and the standard safe harbor is 3 out of 5 years. If you do not generate a profit from the activity, from the hobby-based business for out of 5 years, IRS will consider that activity as a mere hobby. And as I say, once they make that determination that it's just a hobby, not a business, you're not going to be able to legally and safely claim a loss or the deductions, claim expenses beyond the profit that you beyond the income that you receive from that activity. So be careful on that. And you should keep really meticulous records if you make a lot of deductions every year. And I'm just thinking that with the introduction of the side hustle, you might say, in the workforce where you're now considered to be in the gig economy, you have to keep adequate records so you can substantiate those expenses that you're deducting. The other thing too is that is very important is the record keeping, and this broadcaster will endeavor to focus on some record keeping tips and suggestions for keeping those records available in case you're questioned. Okay, what are some of the moving on to a different subject? There's a lot of myths out there about the debt collectors. How many of us may have received from a call or a letter from a debt collector? And, some taxpayers may be just ignoring those calls and ignoring the letters. That's not a good idea. Ignoring calls from a debt collector will not stop the collection process. Reputable collection agencies train their account managers to offer you flexible repayment plans that actually fit your budget. Maintaining an open dialogue could help you to avoid further calls and letters. Does a charge off by me mean I don't have to pay? Well, that's false. That's a common misunderstanding that if a debt is charged off, you don't have to repay it. Well, as a consumer, you're still responsible for all outstanding debts. What makes the charge off debt different is that you may have to pay a new creditor that purchased the charge off credit. The charge off credit just doesn't disappear. Some people think that a debt collector cannot verify that the account is yours. Well, reputable collection agencies always have account information right from the original creditor. And you have a right, of course, to request this information. Debt collectors have a job to make sure they're collecting from the right people. In other words, they've already determined the responsible party before making any contacts. And then another huge myth, really, some people think that debt collectors are not flexible when it comes to paying your back debts off. Well, that's false. One of the benefits of working with a debt collector is flexibility. They offer repayment plans that are designed to meet all budgets. And I do mean all budgets. Okay, since we have talked about folks in the gig economy, IRS does have a lot of guidance for folks who earn income through the gig economy. From demanding, from providing on-demand services or goods, through an online application or an online site. And just think Uber, Lyft, Etsy, ETSY. Instacart, DoorDash, Rover, Airbnb, and platforms similar to that on the internet. um, there's a page on the agency website that helps folks who get paid for this work to be able to easily find the resources needed to understand their tax obligations. It guides people to rules on filing requirements, business write-offs, estimated payments, and record keeping. That website is www.kiplinger.com/letter links/sharing. Again, kiplinger.com /letter links/sharing for all of the details. Okay, the government auditors have been known to chastise IRS on its improper payments of earned income tax credits. Actually, that earned income tax credit, was probably originally one of the main areas of abuse by taxpayers. But recently, it's estimated that IRS has wrongly refunded $21.9 billion in earned income tax credits for the fiscal year just finished in 2023. And that generated a 33% improper payment rate. Compare this with with 2022, the previous year, in which IRS paid out in error $18 billion in erroneous earned income tax credits. So this is an area that's heavily monitored. And if you do use that or do apply or try to use that earned income tax credit, it would be highly advisable to contact a tax professional to make sure that you're following all the guidelines. The IRS has proposed some guidance on a rule that was included in the 2018 law that involved getting timely notices to taxpayers before IRS contacts a third party for information about you. The IRS reform law requires that the agency give them at least 45 days advance notice. And then the contact with the third party must then occur no later than a year from the end of the 45-day notice. IRS is touting online accounts for individuals. Some of the features that if you're able to get through all of the security rules and the security stipulations, but once that system it gets fully implanted, that would allow you to access income tax transcripts. You could get digital copies of some IRS notices. Folks who owe taxes can see their outstanding balance. They can review payment plan options. They can make payments, schedule or cancel future payments, and get virtual assistance. And you can more easily coordinate with your tax advisor on the IRS power of attorney forms, provided that you have a Tax Pro online account set up with the agency. So that's all good. This reporter did at least register, but I can tell you that setting up those accounts requires all kinds of additional secondary assurances and secondary levels of security procedures that have to be passed. You might be might be well advised that beware of emails from scammers who are offering to help you set up those IRS online accounts. The scandalers are making these offers to steal your personal information. Oftentimes, they'll ask you for your address, for your social security number, even ask you for your photo ID, and they'll use that for nefarious purposes, such as filing a false tax return. So, if you get one of those communications, now offering help to set up an IRS account, I would certainly um, avoid those. And unless you are, and avoid that entirely before taking any steps to set it up. Contact a tax professional to get some guidance so you won't be scammed. The the have you received a robocall or on your cell phone that is referencing a national tax relief program? Well, that's a huge national scam. The report is that millions of these robocalls went out between November 1st, 2023 and January 31st of this year. What they were pre-recorded message saying that the caller was from the National Tax Relief Program, which was offering tax debt relief services. And then they were asked to provide their personal information. Wow. Including their date of birth and social security number. Well, the Federal Communications Commission investigated this and then sent a cease and desist letter to Very Wave Telco LLC. And that was the company that was originating these robocalls, but their name was Very Wave, VERIWAVE, Very Wave Telco LLC. Just another, another um, warning to taxpayers. Okay, we have a few questions that have been submitted. The first one is, I own a residential rental property, and I put a new roof on it one of my properties last month. Question is, can I fully deduct the cost of the roof on the Schedule E of my 2024 Form 1040? Well, the answer is you can't really deduct that entire cost in 1 year, but you can depreciate it over 27 and a half years. And that's the standard depreciation rate that you would apply if you have rental properties. The new roof that you installed is treated as an improvement to the rental property and is treated separately from the underlying property for depreciation purposes. Now, this means that the cost of the roof is, as I say, is depreciated over 27 and a half years. And that's the same as the residential rental property, which you also would depreciate over 27 and a half years. When would you start that depreciation year? That would be 2024. That would be the year that you actually put the new roof on. Another question. I'm planning to take out a reverse mortgage on my primary residence. Question is, will I owe federal income tax on the money that I receive in the transaction? The answer is no. The payments that you get from the reverse mortgage are treated as non-taxable loan proceeds. So I know that if you itemize, you cannot deduct on Schedule EA of the 1040 the interest that you eventually pay. That's because you're not using the reverse mortgage proceeds to buy, build, or substantially improve the home that is securing the mortgage. If you are paying interest, you would report that interest on the Schedule E if you have rental income, not on the Schedule A, which really, now the Schedule A, that would apply to your personal residence, not to the rental home. Okay. Another question. My business just received the employee retention tax credit for 2021 wages. Must my firm amend its 2021 income tax return to reflect the ERTC, the uh, employee retention tax credit refund? Well, the answer is yes. If your business previously deducted the wages on that return, the ERTC, the employee retention tax credit, that reduces the wages paid deduction on the your employer's income tax return. So, since your firm got the tax credit after filing its 2021 return, it must amend that return to reduce the wages deduction by the ERTC received. You cannot treat the ERTC refund as income in 2024, the year you received it. Keep in mind that examiners at the IRS are looking at this very issue very closely because it's a common compliance error. So the um, um, we've mentioned this in past programs, but I think that since we have passed the filing season for 2023, I'm certain that there's a goodly number of you who have discovered that you need to amend the return. Here's some tips to be aware of. The first one is you generally have 3 years from the due date of your original 1040 form, but there are exceptions to the rule. You know, if you're due a refund on the original 1040, the wise thing to do is to wait to receive it before filing the 1040 amended return. So the two don't pass in the mail. So if you've already filed the return, but you're waiting for a refund, wait for that refund to show up, and then file the amendment. You can electronically file an amendment using available tax software products. Of course, you can always file on paper, but you know, as you have become aware, if you happen to file your original return on paper, then you have to also file it a paper form 1040 to amend it, and then mail it to IRS. So paper with paper again. Now, if you're amending for multiple years, use a separate 1040X for each year. That's extremely extreme. Don't try to combine them on a several years on just one 1040 amendment form. E-file is if you're e-filing, you can request direct deposit of your refund into your bank accounts and into separate bank accounts. I believe you can split that refund up into three separate accounts. But that feature does not apply if you're mailing in a paper amended return. It's taking IRS over 20 weeks to work on the e-file paper amended return. I can remember not long ago where it was up to 20 weeks. Now they're saying it would take over 20 weeks. And they are giving themselves that additional time past 20 weeks to actually process that return. And of course, if it's out of paper, wow, amended return, you can. I don't think they've even stated how long that would take. They've made a lot of progress on their backlog of unprocessed original returns, that piled up during the COVID years. But that amended return inventory does seem to still be rising. As of October 27th of last year, they had 2.5 million filed business and individual amended returns in their inventory to be worked on. And so it keeps going up. Now you compare that with the previous year in 2022, the October benchmark in 2022, they had 2 million returns backup, for amended returns. If you want to know where your amended return is amongst all of the other millions of returns, you can go online and check where's my amended return to check the status of a file 1040X. If you are on a different area, if you're claiming the foreign earned income tax exclusion, keep in mind that is an audit red flag. Wow, they have really increased the exclusion. The folks who citizens who work overseas can exclude now for the current year for 2024. That's now up to $126,500, 126,000 of their earned income they can apply or claim that amount of exclusion if they were bona fide residents of another country for the entire year, or they were outside the United States for at least 330 complete days in a 12-month span. The worker also must have had a tax home in the foreign country. Keep in mind, generally, an individual will not be treated as having a tax home overseas if he or she keeps their home in the United States. But this doesn't apply, of course, to people who are in the combat zones. You have to attach a Form 2555 to the 1040 to claim the foreign earned income exclusion. IRS does acknowledge that their agents, they actively sniff out folks who erroneously take this break. And to promote the compliance, IRS uses exams and educational outreach. And the areas that they focus on to sniff out the ones who are taking the tax break erroneously are people such as filers with minimal ties to the country they work in, folks who keep an abode in the United States. Many folks, and that covers folks like flight attendants and pilots, plus employees of government agencies who mistakenly claim the exclusion on their returns when they are just working, overseas. So that is that's an area that you want to look out for. There is IRS has made known that there is a IRS free direct file program to file the 1040s. You can get a step-by-step guide and online support from IRS themselves, and you can use your smartphone, your laptop, or any other device to e-file. But keep in mind that eligibility is very limited. Filers must live in one of the following 12 states. Do you live in one of these 12 states? They are Arizona, California, Florida, Massachusetts, Nevada, New Hampshire, New York, South Dakota, Tennessee, Texas, Washington, or Wyoming. If you live in one of those states, you are also restricted to having only certain types of income, and that would be wages, Social Security benefits, unemployment compensation, and or $1,500 or less of interest income. In addition, your W-2 wages reported on your 1040 generally cannot exceed $200,000. You're also restricted to taking just the standard deduction, not itemizing. If you're itemizing, that makes you ineligible for for this pilot program. Folks who bought health insurance through the marketplace, through the Obama marketplace, do not qualify, and you can claim only uh, 3 credits in total. You can claim the 2,000 per child credit, the $500 credit for other dependents, and the earned income tax credit. So those 3 credits that you can claim with this special free file, direct file program, the 2,000 per child credit, the $500 credit for other dependents, and the earned income tax credit. So, and also another requirement of that free file program is you must have set up an IRS account with the ID-me account. That's ID dot me account. Now, if you don't already have an ID.me account, go to www.directfile.irs.gov. Let me repeat that again, www.directfile.irs.gov. To check on that pilot program and check your that actually right now, that's just from seeing these qualifications again. Those qualifications are pretty restrictive, but I'm certain there are some taxpayers that can benefit from that. But as I say, you have to live in a certain state, one of 12 states. You can only have certain types of income, your wages, Social Security, unemployment, and $1,500 or less of interest income. That really weeds out a lot of folks, especially who have the gig economy, self-employment. Um, it would help folks whose wages are less than $200,000, and it cuts out those who may be itemizing because they're not eligible for that product, for that pilot, and it weeds out those who bought health insurance through the marketplace, Obamacare marketplace. Then keep in mind you can only claim one of those 3 credits: the child tax credit, $2,000 child tax credit, the $500 credit for other dependents, and the earned income tax credits. So the tax filing season for 2023 has gone surprisingly fairly smoothly so far, as reported. Um, for example, folks who call IRS's toll-free lines, well, wow, they can actually reach an operator without waiting, 10 hours during the day. But they are actually publicizing now that you could actually reach someone even after a 2-minute average wait time. I mean, that's a huge change from past extremely extended wait times, amounting to up to literally hours, and oftentimes waiting the entire workday. IRS has enhanced their refund tool, so it really does provide a lot more information about the filer's refund status than ever before. Um, the but the IRS has paid overall. They paid fewer refunds to individuals when compared with 2023. Although the average refund is up a bit, the total number of refunds and the total amount refunded has been significantly lower. That's along with the total 1040 filings. So keep in mind that there has been one real stickler for the 2023 tax filing. That is, if you got a subsidy for buying health coverage on the exchanges, that is on the Obamacare exchange last year. If you did not accompany that tax return with a completed 8962 form, wow, the IRS has just simply been rejecting out of hand any 2023 tax return that had not without that comes in without a completed 8962 form, and that's basic what that is. That's the form that you have to submit to reconcile the advances paid to your insurance company to lower your premiums and reconcile that amount with the actual health premium tax credit that you're entitled to. So what is that 8962 again? Is to reconcile the actual premium tax credit that you're actually entitled to with the advance that the insurance company was paid to lower your premium. So that reconciliation has to be completed and attached to your 1040 for 2023. Otherwise, they'll just stop and will not process the return with this, and they have already sent notice to taxpayers that their return has been the deadline, you might say, until that form is completed. They will, at least IRS will, let you know that you need to refile your 1040 with that 8962 form, or explain why it's not attached. But they will mail you a letter asking you for that 8962 form. Recommendation is to hopefully you're in contact with a tax professional to help you through that particular process. For those who itemize, keep in mind that the medical expenses are still available. Keep in mind that not all health and wellness costs are deductible medical expenses, nor can you pay for them with your health savings account or your FSA. It says IRS has stated that some companies are misrepresenting the circumstances under which food and wellness expenses can be paid or reimbursed tax-free through the SHS health savings accounts or other similar health spending arrangements. Most food, weight loss supplements, or low-calorie beverages are not eligible. One important rule to keep in mind to qualify as a medical expense is that the cost must be incurred primarily to alleviate or to prevent a physical or mental disability or illness. For example, the cost of nutritional supplements qualifies only if they're recommended by a medical practitioner as treatment for a physician-diagnosed medical condition. Before we go off the air, there is some confusion about the increase in the required minimum distribution age to 73. That has been changed and bounced around a lot. But in the Secure 2.0 law, it applies only to owners of IRAs, 401ks, and the like who turn 72 after 2022. Again, it only applies to those folks who turn 72 after 2022. Individuals who turned 73 last year during were required to first start taking the requirement minimum distributions for 2022 when they turned 72. Now, because of the transition from age 72 to 73, no one could opt to delay their first